Welcome back to another episode of the 4F podcast, Faith, Family, Fitness, Finance. And today we're going to be talking about finance. Specifically, we're going to be talking about the buy, borrow, die method. This is what billionaires and even some millionaires do to preserve wealth, avoid taxes, and pass down wealth and assets through their generations and build a legacy that lasts. So we're going to start off with the first piece of the buy, borrow, die, buying. So simple, you buy an asset. This is the key to true wealth. This is the key to building wealth while you sleep. It's really as simple as just buying that first house. And then you step it up whenever you buy a investment property and you have a renter pay off an asset for you. If you're cash flow, you actually can get away with the renters paying off most of your asset, and in 20 years you'll have a house that's free and clear with hundreds and hundreds of thousands of dollars of equity that counts towards your net worth that you can borrow against. This also works for stock portfolios like 401ks that you have at your work. If you have a 401k, you can borrow against that thing. A lot of the times with 401ks, you can borrow around 75-80%, or even TSPs. And in some cases, you can borrow against your Roth IRA. In a self-directed IRA, you can use it to invest in assets. But we're going to now talk about the 401k example. With 401k loans, you can get very low interest rates because the collateral, what the lender will use to take back the loan if you don't pay, will be your stock portfolio, your 401k portfolio. And they want to make sure that the collateral will be worth more than the loan if you don't pay. Same for a car note. That's how collateral works, right? So you can borrow against your 401k to buy assets, buy even more assets. Your 401k, if you use it as a vehicle to borrow against to get higher returns, you can actually put those returns just back into your 401k and really amplify that thing. So now we're going to talk about an example with real estate. Let's say I buy a house at $200,000 today, and when I die, that house is worth $1 million, let's say in 60 years or however long. Well, if I borrow $500,000 from that house as an old man to go towards my retirement, let's say I want to take a trip or I want to do something really cool, and I don't plan on paying this $500,000 back. I'm going to borrow $500,000 from this $1 million investment, from this $1 million house that I paid $100,000 for however many years ago. And I'm not going to pay this loan back. What I'm going to do is I'm going to use this to maybe go towards my retirement, do whatever. And then when I die, here's what happens. Here's what gets really cool about this. Buy, borrow, die. Now we're going to talk about the die part. So when I die, that $500,000 loan, that goes down through my estate, and my heirs are responsible for that, yes. But my house is worth $1 million. Remember that. So if my house is worth $1 million, whenever I die, my house gets what's called a step up in basis. All that means is that my heirs, when they sell my house, they'll sell it for $1 million, but they won't have to pay tax on the difference between what I bought it at and the fair market value, which in this case would be I bought at 100, I sell at 1 million. They wouldn't have to pay any tax because they get a step up in basis, meaning that they inherited at $1 million. That's the price that they inherited at, and they sell at $1 million. So there's no difference in between the fair market value, the step up price of what they inherited at and what they sell it at. Therefore, they sell for $1 million. They pay off my debt, my loan of $500,000. They collect $500,000 tax-free. This is what rich people do, because if I were to sell my stocks, or if I were to, let's say even just sell my house in that scenario, and I wanted to sell that house, investment property, and I wanted to use that money from the sale of the house to go do some fun stuff, I would have to pay tax on that. And Uncle Sam would steal from me, essentially, because taxes are theft for the most part. We went to war over a 2% tax rate. I would have to pay a large chunk of change on that investment property. Versus, if I borrow against it, I'm only paying interest, like 4%. So, that's the beautiful thing about the buy, borrow, die method. This is what billionaires do, like I said. So, for example, Elon Musk and Bezos, all these guys do it. And there's a lot of other smaller time guys that do it too. But if I'm a billionaire and I earn $1 billion in a year from a job in the form of compensation or salary, well, let's say I'm going to have to pay tax at 40%. 40% of $1 billion is $400 million that I'm having to pay at the end of the year to the government. It's a lot of money. Or let's say I borrow $1 billion from my assets, and my tax rate is my interest rate on that $1 billion loan is 4%. Well, that means that my annual interest cost, 4% of the $1 billion, is going to be $4 million. So I'm going to have to pay $4 million over the course of the year instead of $400 million. Actually, excuse me, that would be 40 million. I got that mistaken. But still, the difference between this is just car math. The difference between 40 million and 400 million is significant. So, as you can see, buying and borrowing and dying is the way that millionaires and billionaires pass down generational wealth. They keep the government out of their pocket, out of their asset book, and it's a really good way to build wealth over the long term. So, quick video. I hope y'all like that. I'm going to make a couple more videos covering some other topics that I've learned for the week. And I hope y'all have a great day.